Hello and welcome to the only channel dedicated to dissecting the intricacies of hard-to-borrow stocks and potential short squeeze setups. Today, we're shining our spotlight on a microcap name that's generating some serious buzz due to an astronomical cost-to-borrow fee, BOXL Corporation, ticker symbol BOXL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. BOXL Corporation, BOXL, operates in the technology and consumer electronics sector. They design, produce, and distribute interactive technology solutions for education, health, corporate, military, and government sectors across the Americas, Europe, the Middle East, Africa, and internationally. Essentially, they are in the business of interactive displays and learning tools. Currently, BOXL has a market cap of a very modest $4.08 million, putting it squarely in microcap territory. And its recent price action has been anything but modest. Show chart BOXL 5-day today, BOXL is up 2.21%. But over the last 5 days, this stock has surged an incredible 134.1%. Looking back a bit further, the last 30 days show a gain of 46.62%. What is cost to borrow and why it matters? So, what makes BOXL particularly interesting for a short squeeze discussion? It all comes down to something called the cost to borrow, or CTB. When you want to short a stock, you first have to borrow shares from someone who owns them, usually through your broker. You then sell these borrowed shares hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. But borrowing shares isn't free. You pay a fee, an interest rate, to the lender. This is the cost to borrow. When a stock becomes hard to borrow, it means there aren't many shares available to short. Demand to short is high, but supply of shares to lend is low. This scarcity drives the cost to borrow fee through the roof. It can even exceed 100% on an annualized basis, meaning short sellers are paying over 100% of the stock's value per year just to maintain their short position. Why this stock is hard to borrow right now. And that brings us to BOXL. Our hard to borrow screener flag BOXL with an annualized cost to borrow fee of a staggering 952.4%. Highlight CEB number, let that sink in. Short sellers in BOXL are paying nearly 9.5 times the stock's value per year just to hold their short positions. This is an extremely high fee, signaling immense demand to short combined with very limited supply of shares available to borrow. BOXL's estimated float, the number of shares readily available for trading, is a tiny 0.5 million shares. Highlight float size. A small float means fewer shares are circulating, making it easier for short interest to represent a significant portion of the available shares. Today's volume for BOXL was 362,138 shares, which is only 0.1 its 30-day average volume of 2,812,190 shares. This low relative volume on the day could be indicative of a generally tight supply. Squeeze mechanics explained. So, what does a super high cost to borrow like BOXL's imply for a short squeeze? It suggests short sellers are under considerable pressure. If the stock price starts to rise, fueled by buying pressure or positive news, these short sellers might be forced to cover their positions to stop their losses from mounting and to avoid paying the exorbitant 952.4% CTB fee indefinitely. Covering a short position means buying back the shares in the open market. This sudden demand to buy can create a self-reinforcing loop. As more short sellers buy to cover, the price rises further, triggering even more short sellers to cover, pushing the price even higher. That's the essence of a short squeeze. Our internal composite squeeze score, which factors in CTB level, momentum, borrower supply, float, and technicals, currently pegs BOXL at 41.0 out of 100. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price is going down, and they are willing to pay a premium to maintain that bet. Dilution risk check. Now let's talk about dilution, a critical factor for any potential squeeze candidate. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While a high CTB might suggest a squeeze, dilution can quickly negate or significantly offset that potential by flooding the market with new shares, making it easier for short sellers to cover or for new shorts to enter. For BOXL, we've found no recent dilutive SEC filings like -1s, -3s, or 424Bs in the last 90 days. This is a positive sign for a squeeze thesis, as it suggests the company hasn't recently added to the share count in a way that would directly counter upward price momentum. Recent reverse split watch. Another important factor for BOXL is its recent reverse stock split. On June 22, 2026, which was 56 days ago, BOXL executed a 1-for-6 reverse stock split. This means that for every 6 shares an investor owned, they now own 1 share, with the price being adjusted proportionally higher. Reverse splits reduce the total number of outstanding shares and consequently the float. In BOXL's case, it would have contributed to its estimated 0.5 million share float. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, as the reduced share count can make the stock appear more attractive or easier to move on low volume. While BOXL is now little beyond their typical 1-month window, the reduced float from the split remains a significant characteristic. It's a pattern, not a guarantee, but it's an important context for BOXL's recent activity. Again, a quick reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For BOXL, with its incredibly high 952.4% cost to borrow and tiny 0.5 million share float, key things to watch would be any significant increase in trading volume. While today's volume was low relative to its average, a sustained increase in buying pressure could quickly put short sellers into a bind. Any news from the company or sector that could be perceived as positive could also serve as a catalyst. Keep an eye on that borrow availability. Although we don't have current real-time data on how many shares are left to borrow, the high CTB suggests it's likely very low. Boxlight Corporation, BOXL presents a fascinating case study in the world of hard-to-borrow stocks. With a near 1,000% annualized cost to borrow and a very tight float, the conditions are certainly noteworthy. While this doesn't guarantee a short squeeze, it certainly puts short sellers on high alert. Remember, understanding these mechanics is key to navigating volatile markets. If you found this deep dive helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you. Thanks for watching, and we'll see you in the next video.